While most people were asleep, something massive began taking shape quietly in the background. A digital economy worth trillions of dollars has been forming, not through hype or viral trends, but through policy shifts, institutional positioning, and long-term strategy. At the same time, the largest asset manager on the planet has been tightening its influence over crypto in ways most people are not paying attention to. This story is not about memecoins, and it is definitely not about getting rich overnight. It is about power, tokenization, and who will ultimately control money, data, identity, and knowledge in the digital age. In this video, I want to walk you through how Bitcoin, BlackRock, and Pi Network are all connected to a much larger transformation that is unfolding right now. And more importantly, why the year 2026 is shaping up to be a turning point that could redefine the entire crypto landscape. Before we dive in, if you want real-time Pi updates, broader crypto trends, and behind-the-scenes insights that don't always make it onto YouTube, you can follow my Telegram and Facebook pages. The links are in the description. Make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss important updates. Now let's talk about what is really happening beneath the surface. At first glance, Bitcoin looks calm. The price moves slowly upward, hovering near major psychological levels that everyone is watching closely. From the outside, it seems almost boring. But underneath that steady movement, something far more complex is taking place. Institutional capital is reshaping how this market behaves. Larry Fink, the CEO of BlackRock, once openly criticized Bitcoin and dismissed crypto as speculation. Fast forward to today, and BlackRock now operates one of the most successful Bitcoin ETFs ever launched. Not only that, but Fink now regularly speaks about tokenization and a future where nearly every asset exists on a shared digital ledger. For many people in the crypto world, this doesn't look like a simple change of opinion. It looks calculated. BlackRock is no longer a spectator. It is one of the most influential forces in Bitcoin and Ethereum markets. Its ETF inflows often dominate daily volume, and its presence alone affects price behavior. There is also a pattern that experienced traders have noticed. Bitcoin often rises steadily during the month, only to drop sharply near the end. According to hedge fund managers, this is partly driven by large institutions buying spot Bitcoin while simultaneously shorting futures. When futures contracts settle, those positions are unwound, creating sudden selling pressure. It looks like weakness, but in reality, it is a structured trade designed to control volatility and manage exposure. Zooming out, this market behavior ties into a much bigger vision. Larry Fink is now closely associated with global economic discussions around tokenization. The idea being pushed is that everything can be turned into a digital asset. Stocks, bonds, real estate, commodities, intellectual property, and even environmental resources. Every asset gets a digital representation. Every transaction becomes traceable. Supporters call it efficiency. Critics call it surveillance. This is where digital identity becomes central. If every asset is tokenized, and every person has a digital identity linked to that system, then participation in the economy becomes programmable. Investigative journalists and policy analysts have warned that such a system could allow unprecedented monitoring of financial behavior. Ownership, access, and permissions could all be controlled at the protocol level. And this is where Pi Network enters the story from a very different angle. For years, millions of people mined Pi on their phones, often criticized for believing in something that had no visible value yet. But value in crypto does not come from hope. It comes from usage. That is what is beginning to change now. Pi Network is slowly transitioning from a mining-focused phase into one centered on real-world utility. Developer activity on Pi is increasing. More applications are being built. Merchants in different regions are testing Pi-based payments. Entire local ecosystems are forming around exchange of goods and services. This shift matters because it moves Pi out of speculation and into actual economic behavior. Beyond payments, Pi is positioning itself within the emerging knowledge economy. The idea is that education, skills, credentials, and creative work can become verifiable digital assets owned directly by individuals. Diplomas could exist as blockchain credentials. Skills could be validated and recognized without relying on centralized gatekeepers. Research could be published on-chain. Creators could be paid directly, without platforms taking control or excessive fees. If this vision succeeds, Pi becomes more than a currency. It becomes infrastructure for digital identity, human capital, and knowledge ownership. That is a fundamentally different value proposition than most crypto projects. Of course, vision alone is not enough. Execution determines everything. And this brings us to the broader trends shaping crypto right now. The first is institutional dominance. Large financial players are no longer ignoring crypto. They are actively shaping it. ETFs, custody services, and regulatory frameworks are being designed to fit crypto into existing financial systems. Banks that once dismissed Bitcoin now recommend limited exposure to their clients. Governments are drafting laws to define who can participate and how. The second trend is aggressive tokenization. Assets of all kinds are being turned into digital representations. Property, stocks, commodities, intellectual property, and credentials are all being prepared for on-chain systems. This trend is accelerating, not slowing down. The third major shift is the move away from pure speculation toward real utility. Users are becoming more selective. Projects that do not solve real problems are losing attention. Platforms that offer payments, identity solutions, and everyday services are gaining relevance. Pi fits directly into this category because it focuses on usability rather than short-term price action. Now comes the real tension. The future of crypto is no longer about price charts alone. It is about control. Traditional financial institutions want regulated, permissioned systems. They prefer stable coins they can monitor, identities they can verify, and rails that fit existing compliance models. From their perspective, crypto should resemble traditional banking, just faster and more digital. Crypto-native communities see it very differently. They want open access, censorship resistance, and decentralized participation. They believe crypto was created to remove gatekeepers, not replace them with new ones. Institutional giants push for a world where everything is tokenized and tracked. Critics warn this could lead to a single global ledger that monitors assets and individuals simultaneously. Pi Network is attempting to carve out a different path, one that prioritizes inclusion, accessibility, and real-world utility for everyday users rather than institutions first. The Pi community is not passive. People are building applications, onboarding merchants, and expanding local ecosystems. This is what real networks look like. Not just charts and speculation, but usage and participation. Security and scalability are becoming increasingly important as adoption grows. Any platform aiming to support millions, or even billions, of users must be able to protect data, secure assets, and operate reliably at scale. Pi is preparing for that challenge as it moves forward. So what does all of this mean for you? It means that 2026 is shaping up to be a defining year. Institutions are positioning themselves. Governments are finalizing frameworks. Corporations are tokenizing assets. Communities are building parallel systems. The mining phase brought people in. The utility phase will decide which projects endure. This is not financial advice. I am not telling you what to buy or sell. The goal here is understanding. Understanding the forces at play, the direction the digital economy is moving, and the choices being made right now that will affect all of us in the future. The digital economy is evolving. The knowledge economy is emerging. The real question is not whether this transformation will happen, but who will control it? If you found this breakdown valuable, support the channel by liking the video, subscribing, and turning on notifications. Follow my Telegram and Facebook pages through the links in the description. And leave a comment below. Are you seeing real Pi utility where you live? Do you trust institutional control over crypto, or do you believe decentralized communities should lead the future? Thanks for watching, and I'll see you in the next one.